Now, we're going to talk in the latter half of this episode how this stair step down in terms of what you pay based on income could open up the door for this to be a good plan for certain people, especially low income earners. But you can also see based on this cliff that it can be really punitive for people who don't understand tax planning. Let's say that we have someone who doesn't understand the importance of the difference between the percentages when it comes to calculating payments under a repayment assistance plan, and they're doing their tax planning and their adjusted gross income is right at $100,000. Well, they would, because they're over $100,000, have to pay 10% of their adjusted gross income towards their loans. That would be $833 a month. Conversely, if somebody who understood the calculation came to them and said, you do realize if you can find the way to reduce that adjusted gross income by just $1, literally $1, instead of paying 10% towards your loans, you would only have to pay 9%. They would reduce that adjusted gross income to $99,999, which leads to a payment of approximately $750 a month. That is a huge difference to say that $1 higher or lower on adjusted gross income is the difference between $83 more per month on a student loan payment. But again, it calls to mind the importance of understanding the structure of your plan. Now, that's the income factor. What's the second factor? The second factor would be the number of children in your household. For the number of children in your household, you get $50 off per child. So if you have 2 children, you take that percentage of whatever you were paying. Let's go to our example of the person who earns $100,000 has 10% of that. That's $833 a month. If they have 2 children, they get to deduct $50 per child, and their student loan payment would be $733 per month.